So something like a 35% decline might be the full extent of the damage to the cloud stocks if we're saved by the Fed. But I just don't see that happening this time, which means we could be looking at more pain. What if we search for price targets instead, levels where the cloud stocks could become more attractive? This could help us, right? Okay, first it's important to recognize that many of them already have reasonable valuations. 18 of the 50 names in our cloud list have single-digit price-to-sales ratio. Yes, which I have no problem with. That includes Cramer Salesforce.com, which is owned by my charitable trust, and fellow cloud king VMware. Then there's New Relic, which has become a terrific turnaround play earlier this year before the recent meltdown. In short, if you want to start picking among the rubble, the cheap cloud stocks, well, these have already come down enough to be worth buying very gradually on the way down. Now, these growth stocks trade based on what's known as the out years, so we should also look at the 2023 sales estimates, because in a month, 2023 will be next year. On those numbers, there are 8 that sell for less than 10 times sales, and those are Workday, which I like very much. Five9, I had them one good quarter. Twilio, not that good a quarter, but very good long-term prospects. Those are the ones I like. What about the more expensive cloud names? Let me help you come up with some downside targets here. There are 8 stocks that trade between 10 and 15 times sales based on 2023 estimates. Let's paint with a broad brush and say they'll become more enticing under 10 times. In that case, you got Qualtrics, DigitalOcean, and ServiceNow. They could be viable down about 10% from here. Coupa Software might need to sink another 13%. Okta would have to decline 28%. Adobe would have to fall 29%. Although Adobe's a bad fit for this method because it's one of the few that trades on earnings, and it's already got a fairly reasonable valuation on an earnings basis. Then there are the cloud stocks that trade between 20 to 30 times sales currently, but more like 15 to 20 times sales using 2023 estimates. I go quiet on these because these are very expensive. Let's say they're more enticing at 15 times sales. Some of these, like UiPath, are already less than 15 times sales if you use the 2023 numbers, though. Others are less than 10% away, like HubSpot. Did you see that today? CrowdStrike, one last week.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.